Good morning. Welcome to another startup learning series with Rohit Jain. Today we are learning about due diligence and term sheets, how investors check everything before investing, and how startups make the deal official. Let's begin. Meet Kabir. He wants to buy a second-hand bicycle. But before he pays, he checks the brake, the seat, and the price. He makes sure everything is safe and fair. This careful checking is exactly what investors do, and that process is called due diligence. So, due diligence means an investor does a full detailed check of a startup before investing. They look at the finances, the founders, the business model, the product, and the growth numbers. They want to be completely sure the company is honest, strong, and worth putting money into. Take a kid's example. It's just like checking a cricket bat before buying it. You test the handle, the wood, the price. You only buy it when everything looks good. That's exactly what investors do with the startups. So, if we take a real business example, when investors checked Flipkart, they studied the customer numbers, the delivery speed, and how much money the company needed. Before investing in Zomato, they checked the restaurants, the delivery network, and the user ratings. Big investors never invest blindly. They always do due diligence first. So, after checking the bicycle, Kabir and the seller write a simple agreement. The price, when he will pick it up, and what repairs the seller will do. This paper is not the final deal, but it shows what both sides have agreed on. This is just like a term sheet. A term sheet is a document with the basic terms of the investment deal. It explains how much money the investor will give, how much ownership they will get, the rights of both sides, and the main rules of the deal. It's not the final legal contract, it's the agreement before the lawyer prepares the final document. Now imagine you and your friends start a lemonade stand. You write, you bring the lemons, I bring the sugar, and we share profit 50-50. This simple paper is exactly like a term sheet, a basic agreement before starting. When investors invest in companies like Freshworks or Nykaa, the term sheet includes the investment amount, the percentage of company the investor gets, the voting rights, and what happens if a founder leaves. Only after both sides agree on the term sheet, the lawyers create the final legal contract. Summary. So, due diligence means checking everything carefully before investing. A term sheet means writing down the basic terms of the deal before signing the final contract. Both protect the startup and the investor and ensures everything is clear before big money comes in. We have just completed a startup learning series on due diligence and term sheets. In the next lesson, we will learn about equity, ESOPs, and the cap table, how ownership works in startups. Keep learning, keep building with Proplearn. Thank you.